2 is predominantly going to be on chapters 3 and 4. So hopefully that will give you some insight into what that content is about. Guys, the session will be recorded. So you will have access to it to reflect back on it at a later point. And I'll do my very best to keep an eye on the chat. So if there's any questions as we go along at all, please just shout up. For those of you that weren't here last week, my name's Helena and I'm one of the tutors at Premier Training. So let's kick off, guys. Let's have a look at session 2. So session, as I said, with chapters 3 and 4. And 3 and 4 feeds very nicely to a side. This is the purpose of the journal, what it does. In essence, guys, it's just a different way of capturing double entry. And we're going to have a look at processing some different types of transactions by journal. So we did a lot of work on double entry in the first module. We're just going to extend that knowledge today. And then the back end of the session, we're going to look at the cash book. And the cash book should be something you're quite familiar with based on your work for Introduction to Bookkeeping. But we're going to look at it in a slightly different way. We're going to look at our records in terms of the bank balances, i.e. the cash book. We're going to have a look at the bank's records in terms of bank balances. And then we're going to do a comparison. We're going to do a bank reconciliation. Okay, so that's what I aim to get through. So let's look at what a journal is, importantly, why it's required. Most businesses, so you guys may have jobs and you may be responsible for inputting sales invoices, dealing with purchase invoices, making payments, whatever it is. If you've got an accounting software package, you'll input that transaction. So you'll input the invoice or the credit note or the payment, and you'll click on a few buttons, you'll go through a few screens, you'll input amounts, you'll input customer account names, you'll look at general ledger accounts, but you won't do the double entry because the double entry takes place behind. The system will automatically does that for you. It knows what the double entry is when you input a sales invoice. It knows what the double entry is for a purchase invoice, a return. So the system takes care of that for you. But even if you operate with an accounting software package, there are still going to be certain transactions that don't happen that often, that require your intervention, your knowledge and skills. There's still those types of transactions that there's not an automated process for. And those are the type of transactions we're going to have a look at this afternoon. But regardless, guys, of whether we're using ledger accounts or whether we're doing journals, debits and credits don't change. Debits and credits have got to balance. Your double entry must always agree. So debits must have an equal and opposite credit. The only slightly different thing is the way it looks. It's very slightly different. And we always recommend that it has an appropriate narrative. And that doesn't have to be War and Peace. It just has to be something clear and concise. The idea behind that is if somebody from a non-financial background is looking at that journal, debits and credits are meaningless to them. But does your narrative indicate what you're trying to achieve? Because it should, and that's what we're trying to get at today. Okay. So the types of unusual transactions or transactions that perhaps don't occur frequently, where there's not that automatic process for. And there's certainly the top two, guys, we're going to look at this afternoon. So an irrecoverable debt. What happens when a receivable fails to make their payment? We're going to look at that shortly. Maybe we're transitioning from an Excel computer system, so a very manual driven computer system. Maybe we're transitioning onto perhaps Sage, for example, or Oracle, SAP, Pegasus, whatever it is your software is. We need to input our opening entries. We need to start our business with the appropriate balances. And we'll look at that this afternoon too. What about the purchase of a non-current asset? Well, we absolutely need to recover the value of that. We need to record it because that adds value to our business. Correction of errors is something I wanted to mention, but that's really the focus of next week's session. So what happens when things go wrong? And that's going to be the focus of week 3. So bear with me on that one and we'll revisit that in just over a week's time. And then the last item on there is your year-end adjustments. And really, guys, we won't be touching that really in terms of level 2, but it's something that's more appropriate for level 3. So when you progress and you start to look at preparing your financial statements, you'll need to do things like depreciation, accruals, prepayments, inventory valuation. There's not an automated process for that. That comes from the knowledge and skills of the bookkeeper, the accountant, and that's you guys. And that's something that has to be completed via a journal, and you'll get exposure to as you progress. So an irrecoverable debt, what is it? Well, whenever a business allows a customer to buy on credit, there's always a risk to that transaction. And as a business, you will take every precaution out there to reduce that risk. You will ascertain credit reports, you will do credit checks, you may even gain trade references. You'll hopefully have a very proactive accounts receivable team or a credit control function that looks after those customer balances, that hopefully traces those debts. But there's still a risk to that transaction. And that accounts receivable or credit control team, they'll be making phone calls to your customers, they'll be chasing them with letters, with statements. But there may be occasions, hopefully not many, but there may be occasions when that customer can't fulfill the debt. One of the things I haven't mentioned, I suppose, is legal proceedings. And of course, that is an option. But the reality, guys, is if you're pursuing a debt of £100, legal proceedings is quite a costly process. And probably it's not cost effective to go down that route. And that's sadly when the debt becomes irrecoverable. And when it does, that's an expense to our business. Because ultimately we've sold goods and we're never going to receive the funds for them. And that's a cost to our business and we need to capture that. So how do we capture it? Well, the double entry for an irrecoverable debt is to debit irrecoverable debts. And that's an expense, just the value of the goods. And what that does, guys, is it captures the value of goods we've sold that we'll never recover the funds for. So we debit irrecoverable debts with the value of the goods. We debit the VAT account with a VAT figure. And there's some very specific rules in terms of when HMRC allows us to reclaim the VAT back on irrecoverable debts. We don't have to concern ourselves with those at level 2. That's something that we get exposure to as we progress. So for now, we're able to reclaim the VAT on our irrecoverable debts, and we do so by debiting our VAT control. And then sadly, we need to reflect the fact that we're not going to recover those funds from our customers. So we need to reduce our receivables ledger control account with the full value, because they're not going to pay us for the goods and they're not going to pay us for the VAT. And that's the double entry that takes place in the general ledger. Guys, if any of you were around last week, is there another entry that I perhaps need to consider? Is there another ledger that I may need to think about? Thinking about reconciliations and some of the work we did last week. What do you think? And please don't worry if you're unsure, that's fine. Yeah, Kim, well done, excellent. Yeah, absolutely. It's a customer account, isn't it? Because last week, if you were with me, you were able to join me. We talked about the reconciliation between the control account and the receivables ledger, that lower ledger. So absolutely, there should be a further credit into the customer's accounts, the receivables account. And that should mirror the entry that you put through, the receivables ledger control. In terms of this assessment, guys, you're only going to be concerned with the entry into the general ledger. Okay, so you won't have to do that entry into the receivables ledger. But of course, what we're training you for here, guys, is to go out and do this job. So the complete picture is what I want to show you. In terms of the exam, it's just the general entry you're going to have to deal with. And guys, this is a new concept. This is a new transaction that we've introduced this afternoon. So if anyone wants to take a quick picture of that slide, please feel free to, because we are going to do an activity that we may need to reflect back on that. So I'll just give you a moment. If you want to grab your phone and have a quick picture, take one now. Okay. Okay, guys. So let's have a look at our first activity, and I'll walk you through this one. So Woodall Limited has total receivables, so their total customer balance is 28,500. we're told that an amount of 1,500 due for A. Bradley has been declared irrecoverable. So our customer balance is 28,500. 1,500 of that relates to A. Bradley, and that 1,500 is included in the 28,500. We've been given the following ledger accounts. So we've got a balance brought down on the debit side of our receivables ledger control account. We're comfortable with that. It's a debit, it's an asset. We're clear with that. We've got an irrecoverable debt account, which doesn't have any transactions in at the moment. There's no irrecoverable debts being recorded at the moment. And we've got a VAT account with a balance brought down of £2,000. The amount of 1,500, guys, includes VAT. So we need to be careful that we're stripping that VAT out correctly. And we're going to follow the double entry I've just shown you. We're going to debit irrecoverable debts with an amount of £1,250. And that's just the value of the goods. That records the expense to my business. I've sold goods amounting to £1,250 that I'm never going to receive the funds for. I'm going to debit the VAT because I can reclaim it. When I made the sale, when I recorded the VAT on the sale, I'd have recorded that VAT on the credit side. I'm no longer going to collect that VAT, guys, so that HMRC says that I can claim it back. So debit to the VAT control of £250. And I need to reduce what my receivables owe me. And I'm going to do that by crediting the receivables ledger control account. So now, guys, my customers don't owe me 28,500. They owe me 27,000. Yeah. So if I was to balance the account off at this moment in time, the balance brought down on that receivables account, 27,000. And those are the entries in the general ledger. And those will be the entries that you have to deal with in your exam. But of course, just for completeness, you probably guessed what I was going to say. I want to show you what that looks like in the receivables ledger. And therefore, in the receivables ledger, there'll be an account with A. Bradley on, and there'll be a balance brought down of £1,500 in that account. A. Bradley is irrecoverable. I need to write off that amount, and therefore, all I'm going to do is mirror the entry that I put through the control account. So I will credit A. Bradley's account with £1,500. A. Bradley no longer owes me anything. It's written off, and I've dealt with that transaction. Guys, are you all okay? Is there any questions before I ask you to have a look at doing one for me? Are you all okay? Perfect. Lovely. Okay. So, very similar. Jones & Co. have total receivables, and they amount to £64,000. An amount for 2,100 due for Williams has been declared irrecoverable. So this feels exactly like the first question does. The names are different, the amounts are different, the principles are the same. But this time, guys, I want you to do the double entry, but I want you to do it in a journal format for me. Okay? So we'll take it step by step. So all I want you to do first is tell me what you think the first debit entry goes to. What's the account name of the first debit? And if you want to use any abbreviations, I'm absolutely fine with that. Well done, Kim. Perfect. So we're going to debit an account called the irrecoverable debt. Perfect. And remember, guys, I'm only going to debit that account with the value of the goods. So debit irrecoverable with 1,750. Perfect. There's another debit. Where does that one go? Excellent, guys. Well done. Perfect. Certainly does. I can recover that VAT. I need to debit the VAT. And last but not least, the credit entry. Balancing up my journal. Where does that go, guys? What account am I going to credit? Excellent. Perfect. Excellent, guys. Really well done. I'm going to credit the receivables ledger control account. Absolutely. I'm crediting the receivables ledger control account to reflect that I no longer owe. So my customers no longer owe me 2,100. And those are all the entries that will be required in the general ledger. And in terms of your assessment, that's all that's going to be expected of you. We've discussed previously that there would be a further entry into the receivables account of Williams, but we don't have to concern ourselves with that in terms of this aspect of the exam. Okay, that's really well done. Guys, and that really concludes irrecoverable debt. So in essence, you will have a question in your exam asking you to capture, to recognise an irrecoverable debt. And it will be generally presented in a journal format, which is the format you've got in front of you today. It's double entry, guys. It's just presented in a slightly different way. Any questions on that, guys? Anything you need me to re-clarify before we move on? Okay. So let's have a look at something slightly different, but still using the journal principle. What is the double entry for that transaction? So the owner invests £10,000 of his money into the business bank account. And this is something you would have done when you did Introduction to Bookkeeping. When you first started your debits and your credits, this is one of the very early transactions you'd have come across. When the owner starts the business and he introduces funds into the business, what's the debit? Where do we debit? What account do we debit that £10,000 to? Any ideas? Lovely. Excellent. Yeah, spot on. The bank account. Yeah, 3 bank accounts. Well done, guys. Absolutely. We debit the bank account, don't we? Because we're wanting to increase the asset of bank. We're wanting to record the fact that money has been deposited in the bank. So where do we credit then, guys? Where's the credit going through? Yeah, perfect. Lovely, lovely. Absolutely. We've got 3 nice capital accounts there. Spot on. Well done. Yeah, so we clearly know our stuff in terms of Introduction to Bookkeeping. Well done. And of course, guys, what we need to do, remember, if this journal was viewed by somebody from a non-financial background, debits and credits are meaningless. So what appropriate narrative could we have? It doesn't have to be War and Peace, something short and snappy. Transfer of £10,000 into the business bank account by the owner. Or you could even replicate kind of the question and recording investment of £10,000 of the owner's money. It doesn't have to be complicated. It doesn't have to be paragraphs. A quick snappy sentence does the job. Okay, well done. This time around, perhaps a little bit longer, but A. Harris provides us with some following opening balances. And all we have to do is complete the journal. So imagine this is a scenario now, guys, where you are transitioning perhaps from a manual bookkeeping system to a computerized accounting software package. You would have to enter these as opening balances. So I'm just going to go down them one by one and ask you just to tell me whether they're debit or credit balances. As you do that, as you tell me whether they're debits and credits, try in your head and think why they are debits or credits. If you're telling me something's a debit, is it because it's an asset? Is it an expense? Is it a purchase? Just try and have that thought process, because having that will really help as you go through your studies. It will really head in that knowledge. So the first one, cash. £170, debit or credit, guys? Lovely, lovely. Excellent. Certainly is. It's debit. It's an asset of the business. It's something we own. Perfect. Well done. What about the bank? Absolutely. The bank, of course, you'd probably have talked about previously with Sam when you did Introduction to Bookkeeping. It's a funny one, isn't it? Because it could be a debit or it could be a credit. It depends upon whether you've got funds at the bank or whether you're overdrawn. But you're always safe to assume, as you guys have, guys, that's well done, that if it's not specified, it absolutely is a debit. It's an asset. Well done. What about your inventory? Like it's your stock at the end of the period. What do you think about that one? Excellent. Lovely, guys. Yeah, really well done. Your inventory is an asset. It's a current asset because hopefully it will generate you cash in a future period. So well done. I'm going to give you a clue now. So machinery and computer equipment I'm going to put together. So what do you think those two are? Are they debits or are they credit balances? Perfect. We definitely know our debits and credits. This is excellent. Well done. Okay. The debits, they're non-current assets of the business. We're going to utilise those for periods of probably longer than 12 months, and that will help us operate our business. Excellent, guys. Well done. Receivables. So this is in essence the balance from your receivables ledger control account. We did a lot of work on this last week if you were with me. Yeah, perfect. Yeah, it's a debit. It's an asset. Well done. Guys, these are current assets of the business because, again, it's money that we're owed. So we've got cash coming into our business. Well done. And we also did quite a bit of work on the payables ledger control account. So what's that balance, guys? That 2,450. Perfect. It certainly is a credit. And it's a credit because it's a liability. Yeah. We owe our suppliers some funds. And then last but not least, what about the capital? Is that a debit or a credit? Wonderful. I'm super impressed. Well done. Absolutely. It's a credit. It's capital because it recognises the investment made from the owner. And I always want to say there, it recognises the cash investment from the owner, but that would be wrong because capital can be any investment the owner's made. So yes, it may be cash, but it may also be the value of any assets that the owner has introduced into the business. So it recognises that investment. Spot on, guys. And now this is the moment of truth. So if we've done that correctly, fingers crossed, we'll have a list of debits and a list of credits that agree. So this is time when I need you to reach for your calculators and add those balances up and tell me, do they agree? And if they do, on what figure? And while you do that, I'll sit here with everything crossed. Okay, guys. So debits and credits, do they agree? And if they do, on what figure? Excellent, guys. And that was done really super quick. I'm super impressed. So it certainly does. £17,470. My debits, my credits, they have to agree because that's double entry. That's a journal that you've got in front of you. So it's not ledger account, but the principle's the same. You still have to understand which debits, which are debit account balances and which are credits. It's a journal, so really we should have a narrative. So nothing complicated, nothing any more involved than perhaps saying, recording the opening balances of the business for A. Harris. Yeah, it doesn't have to be complicated and it doesn't have to be lengthy. And that, guys, brings the first part of the session to a close. So before I move on and look at cash books and bank recs, have you got any questions about journals? Anything at all that you'd need me to re-clarify? Okay. Fab. If anything does crop up, guys, if you think, oh, I'm not sure, on reflection, you want me to re-clarify anything, at the end of the session, you'll have my email address. So by all means, you'll be able to get in touch with me if you need to. Let's have a look at cash books. So this is something that you've got familiarity with from your first module. We're going to look at it in a slightly different aspect in terms of this assessment. The cash balance of a business is a super, super important balance because without cash, how do you pay your staff? How do you pay your suppliers, your utility company? How do you operate? And therefore, it's quite a high profile figure, and consequently, it's highly managed by a business. So it has a lot of attention. The cash book, obviously, is where that attention belongs. You or I'm sure, probably receive bank statements from our financial provider, and they probably come in once a month, maybe through the post, or quite possibly through an online platform. But if you think about a business that you're associated with, maybe your employer, or just maybe any company that you perhaps you go to on a weekly basis, you think of the volume of transactions that they would have, the sales, the purchases, the recording of the expenses, the payments to suppliers, the receipts from customers. The volume of transaction, guys, would be vast, and having a monthly bank statement wouldn't do the job. And therefore, most businesses are able to electronically download a file on a daily basis. And that just helps them keep on top of transactions and identify any problems should they present themselves. We have to do as a business, and generally it's on a monthly basis. It can be more frequent, but generally you'll find it's a monthly basis, a bank reconciliation. And a bank reconciliation acts as a form of deterrent, because what you're doing is you're comparing the business's records that you're responsible for to the bank's records, and therefore you're comparing your records to an independent party's. Whenever there's cash, there's always a risk of unethical transactions or maybe theft. But because you're comparing two independent sources of data, it makes those unethical transactions a little bit harder to get away with. So it's a good control measure, a bank reconciliation is. And guys, the idea of what we're going to do this afternoon is to understand why there's differences between our records and that at the bank. And there always will be. There will always be a difference between our cash book and our bank statement figures. And the purpose of the work we're going to do is not to get rid of those differences. It's just to understand them and make sure as a business we have awareness of them. Before we had a look at bank reconciliations, guys, I wanted to have a quick view on the opening and balances on the bank statement. A lot of my students, when they first start, they get massively confused with debits and credits, as we all have at some point. Because if you've never done accounts before, if you've never worked in accounts, probably the only exposure you've ever had to debits and credit balances are on your bank statement. And yet when you start studying and we start talking to you about debits and credits, they seem to be completely opposite to what you're used to seeing when you view your bank statement. And there's a reason for that. And as you progress through your studies and you start to understand double entry, I think you're more in a position to be able to appreciate why there's a difference. And that's why I just wanted to take a moment now to reflect on those differences. So when we receive our bank statement, fingers crossed, we've got a credit balance at the top, because that means that we've got funds available, we've got cash in the bank. Yet when we look at our cash book, if we have money at the bank, we say that's an asset and we say it's a debit. But the bank statement says, no, it's a credit. So why is there this difference? Well, we're absolutely right. In our cash book, if we have cash at the bank, it's a debit balance because we're recognising the fact that we own something, and something we own is an asset. We've prepared the cash book, it's our funds, we own it, it's an asset, it's a debit. But when the bank prepares the bank statement, they're preparing it on our behalf. Okay, so they're preparing it from their perspective for our site. Therefore, if we have money deposited at the bank states that that's not their funds, that's our money, and therefore it's funds that they owe to us. And something that they owe is a liability, and therefore they say it's a credit balance. So when we look at the acronym of PEARLS and we use that to understand debits and credits, the debit in our cash book recognises the asset because we've prepared it. The credit on the bank statement recognises the fact that we have funds available at the bank, and the bank is saying that they hold our money, but it's our money, it's a liability to them because they owe that money to us, and therefore it's a credit. So it does work, guys. The logic works. If we're overdrawn, in our cash book, we would recognise that as a credit because we owe the bank money. Yet on our bank statement, it's recognised as a debit. And again, the logic works because when the bank statement has been prepared, the bank are saying that they have a customer, us, we've borrowed money from them and we owe them that money. So they treat us as a receivable, and a receivable is an asset, and assets are debits. And I hope that makes sense. I hope that sort of things, that really does make sense now in terms of why there was that little bit of difference between the logic that you're now applying in your studies compared to the logic that's on your bank statement. And if it doesn't, please feel free to review this slide. And if it doesn't, again, and you still want some more clarification, then I'd gladly have a conversation with you outside of this session. But I really just want to take a moment just to pause and just help you understand why those differences exist. And the logic does apply. So we're going to complete a bank reconciliation, and that bank reconciliation is a comparison of our records, so the cash book, the bank column on the cash book, to the bank statement. And as I said previously, guys, they probably won't agree. There will be a difference. And therefore, we need to complete a reconciliation between the two, which identifies why there's differences and helps us appreciate why those differences exist. Not to remove them, just to help us understand them. I think once you've had practice, you'll like bank statements and bank reconciliations because there's steps to it. And whenever there's steps to a process, it just helps it become more manageable because we can manage the steps and we can manage the processes. So there's 5 steps to consider. I'm going to talk you through them, but I will illustrate them to you and actually do a bank rec with you as well. So step number 1 is to check and agree the opening balances. So do the opening balances agree? And that's looking at the opening balance on our cash book and comparing it to the opening balance on the bank statement. And in an ideal world, we'd say yes, they'll agree. But you know AAT and you know exams, and we don't live in an ideal world. So there's a good chance that those opening balances won't agree. And we need to make sure that we understand the differences and identify them before we carry on. Because if not, we're going to have a bank reconciliation that will never balance. So step 1 is critical, and I'll illustrate that to you in a second. Step 2 is where we're going to have a look at the balances that appear in both. So there'll be certain transactions that are in the cash book and also on the bank statement. And if we were doing this manually, guys, we'd get our highlighters out and we'd make our papers look extremely pretty by highlighting the transactions that are in the bank statement and highlighting the transactions that are on the cash book. Okay, so the ones that appear in both, step 2. Step 3, there will be some transactions that are on the bank statement that are not yet in our cash book. So there'll be some unticked items or unhighlighted items in the bank statement. Step 3 is to deal with those transactions. So the unticked items on the bank statement, we need to manually put them into our cash book. Okay, what type of transactions am I talking about? So these are what we call the updating items. So it may be, guys, that, for example, on the 15th of every month, you pay your mobile phone bill. And you know that you pay £25, and that £25 is for a set amount of data and a set amount of calls. And as long as you don't exceed those, that's the figure you'll pay. But if you were to exceed that allowance, then you'll pay more. So whilst you may know that on the 15th, the 20th, whatever date of the month, your bank is charged with your mobile phone bill, you may not necessarily the amount until it hits. And it's those type of transactions that we're talking about here. Things like bank charges, you may know that there's a charge that's going to hit your account. Maybe you are overdrawn, maybe you've got interest coming, but you won't necessarily know what it is until it hits the bank statement. So these are transactions that you may be aware of, but you don't necessarily know the value of. And therefore, the first time you do is when you see the bank statement. When they're on the bank statement, you'll update them, you'll put them into the debit, credit side of the cash book, whichever's appropriate. And when we've done that, we balance off our cash book and we get ourselves a new balance carried down. And we balance off the cash book, as you know from your first unit, in exactly the same way as any other ledger account. So we find out what the new balance carried down is on the cash book. And that's the figure that we're interested in. That's the figure that we're comparing to our bank statement. So you can see, guys, there's quite a bit of work to do before we can actually get to that comparison. And step 5 is to deal with the unticked items that are in the cash book. And these unticked items will be what we talk about in terms of timing differences. So these will be items that are in our cash book but have not yet cleared the bank. And they're creating the difference between our cash book balance and our bank statement balance. And as I've said repeatedly, guys, today, we're not going to, get rid of this balance, but we need to understand it and we need to make sure we're comfortable with it. When we talk about timing differences, we're going to talk predominantly about 2 things. And those are unpresented checks and outstanding lodgements. They may be new terms to you today. An unpresented cheque appears on the credit side of your cash book. So this is where we've made a payment, we've entered it into our cash book, but it hasn't yet cleared the bank. But it will. It's just timing differences. This is a payment that's been entered onto the credit side of our cash book. It's reduced our cash balance, but it hasn't yet cleared the bank, but it will in a future period. The flip of that is an outstanding lodgement. And these are receipts. This is money coming into our business. And consequently, we enter these transactions on the debit side of our cash book. So this is going to increase our bank balance in terms of the cash book. But they haven't yet cleared the bank. But again, they will. It's just a timing difference. And they will clear in the next period. These timing differences aren't removed in any way, shape or form from our cash book. They're just annotated, they're just documented on the bank reconciliation, and they make up the difference between the cash book balance and the bank statement. Guys, depends on how far you are through this module. This may be the first time you've looked at bank reconciliations, and that possibly is a really useful slide to reflect back on, because that gives you the structure to tackle the questions, the steps which will help us get through this question. The steps that we can follow to make sure we don't overlook a process, to make sure that we're comprehensive in our approach. Okay, guys, it's all very well sitting and looking at a screen that has some steps on it, but let's apply those steps now and let's see how we get on when we do our bank reconciliation. So we've been asked to review a cash book and a bank statement. So we have a cash book balance and we have a bank statement. And I said there's 5 steps we need to apply. So we're now going to go through those 5 steps together and we're going to discuss them to make sure you're comfortable with them. And if at any point I've gone too quick, you don't understand things, please shout up. I'll gladly repeat myself. So step 1 is to agree the opening balances. So the balance brought down in my cash book is £1,890. And I'm comparing that to a balance in my bank statement of £768. And as I said earlier, guys, we don't live in an ideal world. I've got a difference. What is the difference, guys? Can you calculate the difference for me? That's great. Lovely, lovely. Excellent. Yeah, it's quite a big difference, isn't it? It's 1,122. Now, if you were doing this as your job, you'd be sat down with your cash book, with your bank statement, and ideally with last month's bank reconciliation. Okay? Because the difference, the opening difference, will be on last month's bank reconciliation, because it will have been a timing difference from last period. But we're in an exam and we don't have that luxury of information. So it's a mathematical approach now, guys. You've told me the difference is 1,122, and that balance will appear at the top of your bank statement. And you can see it's there. It's a paid in balance. And the reason it's a paid in balance is because last period, it was already in my cash book. Yeah, it was already on the debit side of my cash book. So last period, it would increase my bank figure by 1,122. Hadn't yet cleared the bank, but it has now. And therefore, it's going into the paid in column and it will increase the balance. So when I do step 1, I cross off all 3. And guys, that is a really, really common error people make. They forget step 1. They're so busy trying to highlight the transactions that they can agree. They do forget that first step, and that causes problems later on. At the risk of being repetitive, I just want to talk you through that again, just to reiterate how important it is. I'm going to compare the opening balances in the cash book and the bank statement. They don't agree, and you've told me they don't agree by £1,122. That difference will appear on your bank statement. You just need to find it, and we can quite clearly see it's one of the top transactions. So when you highlight the opening balances and you agree them, you tick them off, you must include that as the opening balance reconciliation, because if you don't, you'll have problems later on. Step 2. This is where we highlight the transactions that appear in both. Guys, when you get into this, you'll find you've got your own little rhythm. Mine is I always, for whatever reason, I go down the paid out column in my bank statement. It doesn't matter the approach as long as you do it all. So the first transaction is £427 on my bank statement, and I can see that on the credit side of my cash book. So I'm going to highlight that off. The next transaction is for £4,200. I can see that in my cash book. I'll highlight that off. I can't see the transaction for £850. Neither can I see the transaction for £275. So I need to come back to those. But I can see the transaction of £1,062. So I'll highlight those off. Turning my attention to the debit side, or the paid in column on my bank statement, I've got two figures, because remember the 1,122 I've already dealt with. So I've got 2,486, and I can't see that on the debit side of my cash book. And I've got 4,110, and again I can't see that on the credit side of the debit side of my cash book. So I've completed step 2. I've ticked off the items that appear in both. Step 3 is to update your cash book with the items that are on your bank statement that haven't yet been put into your cash book. So I'm going to do that next. So the £850 on the paid in column is going to go on the credit side of my cash book. And can you see, guys, I've highlighted it off my bank statement just so it's out the way. I've dealt with it. I also need to record the payment out of £275, and I'm going to do that there. The paid out column in my bank statement is done, but I do need to deal with the paid in column. And there's two transactions, one for £2,486. This is money paid in. This is money increasing my assets, so it's going to go on the debit side of the cash book. And again, I'm highlighting it off my bank statement. I've also got a transaction for £4,110. So I'm going to cross that off, pop that on the debit side of my cash book. If I look at my bank statement now, guys, I've got lots of crosses, lots of circles, lots of blocks. Everything in my bank statement is in my cash book, either because it's naturally occurred in them or because I've put them in there. Okay, so my bank statement is complete. Everything in my bank statement is now in my cash book. So I need to do step 4. And step 4 is to balance off the cash book. Okay, guys, can I ask you to do that for me, please? Please include the items you've just added in. So please include the opening balances. Please include the items that are crossed. Please include the items in blue text that we've just added in. What's the new figure on the cash book? What's the balance carried down? And I appreciate that might take you a couple of minutes, so I will just pause and allow you to do that. So it's just like balancing off a ledger account. We add up our debits, we add up our credits, and we find the difference. And this will ultimately be the figure, guys, that we take forward and we prepare our bank reconciliation with. Don't worry if you're not sure. It's not a test. It really isn't. Excellent. Perfect, guys. Well done. Yeah, it certainly is. There's quite a few figures there to deal with, so I'm impressed you've done it so quickly. So £15,812. Hopefully, it's our balance carried down figure. So let's have a look, is it? It certainly is. Yeah, and ultimately that will be transitioned as a balance brought down on the debit side of the cash book. So you added up your debits, you took away your credits because the credit was the smaller side. The balance carried down was a credit, transitioning to a balance brought down as a debit. So that means, according to my cash book, I think I've got £15,812 in my cash book. But that still doesn't work because it still doesn't agree to the closing balance on my bank statement. And that's okay. I'm not expecting it to, because that's where the bank rec comes in. But can you see, guys, in terms of the assessment, there's quite a bit of work to do before you can actually even do the bank rec, because you've had to do all that ticking off. You've had to do all those 4 steps, all those steps of ticking off, agreeing balances, making sure you've updated your cash book before you can actually get there. Okay. So we're going to do a bank reconciliation that hopefully proves that we've done everything else right. And that's why a lot of students like this question, because you can have some confidence at the end of it that everything, all your marks have been collected nicely. Let's have a look at the bank rec, guys. So we've got a cash book, and all the items that are highlighted in blue I've already dealt with. Okay, they were either naturally in there or we put them in. Okay, we updated them. I think, as a business, my cash book records say that I've got £15,812 in the bank. But if you remember, the bank statement said 1,672, so there was clearly a difference, and it was quite a big difference. And I'm going to start with my balance as per the bank statement of 1,672. And I'm going to take away my unpresented checks. Now, my unpresented checks appear on the credit side of my cash book because I've recorded them as a payment out of my cash book. They haven't yet cleared. Okay. And guys, as you can see, just so I know I've dealt with it, I've crossed it off my cash book, just so I know that I've, at the end of this, I can look at my cash book and think I haven't overlooked anything, I haven't made a silly error. There's only one, but I'm going to put myself a total and a little subtotal. So the 1,672 less the 670 gives me £912. And then I've got 3 outstanding lodgements. And these outstanding lodgements are recognised on the debit side of my cash book because they recognise money coming into the business. I've recorded them in my cash book. They're not yet on the bank statement. And they're for Wood & Sons of 1,200. They're for Harris Brothers of 4,750. And for Fellows Limited of 8,950. Guys, can you total those 3 balances for me? What's the collective balance of those outstanding lodgements? The 1,200, the 4,750, and the 8,950. How much does that come to, guys? Excellent, guys. You've got it. Spot on. Fab. Certainly does. So this is the moment of truth. Does the £912, when added to the 14,900, give me the magic number? And what is that magic number, guys? What should it come back to, or what does it come back to? Perfect, Kim. Well done. Yeah, absolutely. So £912 adding to the 14,900 does indeed give me what the balance as per the cash book is. And the moment of truth is that those 2 figures should agree. And guys, they will agree. If you've done all those steps correctly, if you've followed it through, if you've gone through it systematically, they will agree, giving you a massive confidence boost in the exam because you know you've collected the marks for that question. And that's why, with practice, lots and lots of students like this exam, like this question particularly, because you can get some confidence that you've got the marks awarded for that particular question. And that's it, guys, in terms of today's session. Before I sort of wrap up and conclude, is there any questions based on anything we've done? No. Well, I hope that means that's because you found the session quite informative and quite useful. My contact email address is on there, guys. Obviously, I know you've got your own tutor, so please feel free to contact them independently. But if there's anything that you'd like to take up with me based on what we've talked about tonight, or anything else for that matter, please don't hesitate to get in touch. That's my email address. I am around next week for the final session for bookkeeping controls. It's on Thursday at 5:30, and I very much hope you can join me. Thanks ever so much, guys, and I look forward to seeing you all next week.